You know, most people think they're being smart by keeping their money safe in a bank account. They believe that seeing their balance go up, even slightly, means they're winning. But let me start with something that will make you uncomfortable. If you leave most of your money in cash, thinking you're safe, you're actually choosing a guaranteed loss. Not a risk, not a maybe. You are losing, year after year, silently, invisibly, while life goes on. Let me explain why, and it's simpler than most people think. Imagine inflation runs at 3% per year, and your savings account pays 0.5%. That's a negative 2.5% return. It doesn't sound like much, but over 10 years, that's small. Invisible erosion will shrink your purchasing power by roughly a quarter. Not the numbers in your bank, but what your money can actually buy. And most people never even notice. They feel safe watching nominal balances rise slightly, while reality quietly punishes them. This is a trap, and it's psychological as much as it is mathematical. Humans hate losing more than we enjoy winning. It's why we clutch our cash so tightly, terrified of market volatility. While inflation stealthily picks our pockets, we accept a guaranteed, slow loss to avoid a potential, temporary drop in a stock or an investment. That's not investing. That's fear disguised as prudence. Here's a principle I've learned from studying both life and economics. Always invert the question. Instead of asking, where should I invest? Ask, what will make me lose money for sure? And suddenly the answer becomes painfully obvious. Holding cash in an inflationary environment is choosing certain loss over uncertain gain. You're choosing comfort over reality, and comfort is expensive. Let me tell you another truth, one that isn't about markets but about physics. Oddly enough, there's a principle called entropy. Things naturally move from order to disorder. Cash has entropy. Its purchasing power decays unless you actively do something to preserve it. Meanwhile, compound interest works both ways. Money can grow exponentially in productive assets, but it can also decay exponentially in cash, almost invisibly, until decades later you realize you've lost half your life's work. So what's the real risk? It's not volatility. The real risk is permanent loss of purchasing power. A stock may drop 15% in a year. That's temporary. Cash, in an inflationary environment, guarantees a slow and relentless decline forever. You never get it back. This is where most advice fails. People confuse volatility with risk. The truth is counterintuitive. Taking calculated risks often protects you better than playing it safe. When Warren Buffett and I built our investments, we didn't hold cash for safety. We invested in productive assets, businesses that generate earnings, adapt to inflation, and grow in real terms. Let me give you a concrete example. In the 1970s, we bought See's Candies. People thought we overpaid, but the company had pricing power. Its earnings would rise with inflation. Our investment wasn't speculative. It was productive. Meanwhile, cash in a bank account would have lost value every year. Let's talk about the 5 categories of assets that truly preserve and grow your purchasing power. First, productive businesses. Owning a piece of a great company is fundamentally different from holding cash. Companies with strong brands, low capital requirements, and pricing power naturally adjust for inflation. Coca-Cola, for instance, raises prices when costs go up. Earnings grow. Ownership grows. Cash doesn't. Second, productive real estate. Not just land or a building, but property that generates income. A rental property producing cash flow increases in value alongside inflation. Mortgages remain fixed while rents rise. The income protects and grows your wealth. But beware, managing real estate requires skill, judgment, and work. If you buy the wrong property, you're speculating, not investing. The rule is simple. If the income alone isn't worth owning the property, don't buy it. Third, yourself, your skills and earning potential. Everyone has this asset, yet few invest in it. Benjamin Franklin said, An investment in knowledge pays the best interest. This is literal. If you spend money to increase your skills or education, you multiply your earning power over decades. That growth is immune to market crashes. The critical part is choosing valuable, hard-to-replicate skills. Not hobbies or distractions, but skills the market truly demands. Fourth, carefully selected bonds. Not all bonds are safe. A 30-year bond yielding 4% in a 3% inflation environment barely keeps pace. Short-term, high-quality bonds can be useful for flexibility and optionality, but they're not wealth builders. Treat them as temporary parking, not long-term strategy. Misusing bonds is just slow-motion cash decay disguised as safety. Fifth, useful hard assets. Machinery, productive land, tools, even a reliable vehicle, anything that holds value because it creates real output. Speculative gold or cryptocurrency doesn't count. Assets only matter if they serve a purpose, generate value, or produce income. Function over hope is the rule here. Assets that work for you are the opposite of cash. They fight entropy rather than succumb to it. Now, why do smart people keep failing financially? It's psychology, not intelligence. There are patterns that predictably lead people astray. One is social proof. You keep cash because everyone around you does. Your parents did. Your friends do. Your peers on social media show off their safe savings. Just because something is normal doesn't mean it's right. In some historical cases like post-World Germany or hyperinflation economies, doing what's normal financially was catastrophic. Another is availability bias. Market crashes are dramatic and visible. Inflation slowly erodes your wealth invisibly. The vivid loss scares you, while the quiet decay is ignored. We fear the wrong things. And then there's the deprival superreaction tendency, the emotional overreaction to losing what you have. It drives people to make irrational decisions, accepting guaranteed losses to avoid potential uncertain ones. Recognizing these tendencies is key. You can't eliminate them. You can only plan around them. Here's a mental model I live by. Decide rationally how much to allocate to each type of asset based on analysis, not fear. Stick to it. Rebalance if necessary. Don't check prices daily. Don't panic. The simple, boring plan consistently beats exciting, emotional reactions over decades. Like the tortoise and the hare, it's patience, not speed, that wins. To apply this personally, ask yourself 5 questions. First, what is my circle of competence? Stick to investments you understand. Second, what is my true risk? Inflation-destroying purchasing power is often riskier than market volatility. Third, what is my time horizon? Don't treat short-term cash needs as reasons to avoid long-term growth. Fourth, what are the second-order consequences? Consider long-term impact, not just immediate comfort. Fifth, what does inversion tell me? If I do nothing or act emotionally, what is the likely outcome? Writing these down brings clarity few people ever experience. Let's confront an uncomfortable truth. The reason most people stay poor isn't opportunity, it's irrationality. They follow crowds, avoid numbers, and make emotional decisions. You cannot think yourself rich with affirmations, positivity, or secrets. You become financially secure by avoiding mistakes, understanding compounding, and protecting your purchasing power. Warren and I became wealthy not because we were geniuses, but because we were rational, patient, and consistent. Consider historical examples. During the tech bubble, everyone chased hot stocks. They laughed at us for holding steady businesses. Then the bubble burst. We didn't panic. We stuck to our knowledge, bought sensibly, and held. Being rational looked stupid at first, but proved brilliant in the long run. This pattern repeats endlessly. People chase excitement, panic, and lose while steady. Rational investors prosper. Emergency funds are important. Keep 3 to 6 months of expenses in cash. That's your safety net. Not 3 years, not 5. Anything beyond that should work for you in productive assets. Sitting on excess cash is financial malpractice. It guarantees slow decay while productive alternatives compound wealth. The financial industry often encourages fear because it profits from your mistakes. Advisors sell products that benefit them, not you. True, rational advice is simple. Spend less than you earn, invest the difference wisely, and be patient. That's it. No tricks, no secrets. Time and rationality beat cleverness and activity every single time. Let me show you one final mental model. Opportunity cost. Every dollar left in cash at 0.5%, instead of 7-10%, in productive assets compounds into lost wealth over decades. $100,000 in cash today might be $48,000 in real terms in 30 years. Invested wisely, it could be $700,000 in today's purchasing power. The difference is staggering. One choice leads to slow poverty, the other to financial security. Yes, markets may crash after you invest. That's painful. But history proves that holding for 10 years or 20 has always yielded positive returns. Dollar cost averaging further smooths the timing risk. Waiting for the perfect moment to invest is a fool's choice. It guarantees slow loss while waiting. Focus on process, not prediction. You cannot control market outcomes. You can control rational decision-making, diversification, staying in your circle of competence, and consistent execution. Good process applied over time beats occasional brilliance. Bad process occasionally gets lucky, but usually ends in disaster. Cash is passive. It rots in real terms while you sleep. Productive assets fight entropy. Businesses grow, real estate produces, skills multiply earning power. Carefully chosen bonds provide flexibility, and useful hard assets create value. The difference is clear. One protects you, one diminishes you. The final lesson: invert your thinking. Ask, how can I avoid staying poor? Rather than, how can I get rich? Avoid volunteering to lose purchasing power. Don't confuse nominal numbers with real value. Don't let fear drive you to financial ruin. Awareness, patience, and rationality, not genius or luck, are your tools. Warren and I built Berkshire Hathaway by being rational and consistent over decades. We avoided stupid mistakes, let compound interest work, and invested in productive assets. You may not build a 500 billion company, but you can build financial comfort, avoid poverty, and secure your future. The principles are the same. Now take control. Analyze your finances honestly. Identify your circle of competence. Allocate intelligently. Stick to your plan. Ignore fear, ignore greed. Focus on rational action. Every day you delay is opportunity lost to inflation and entropy. Choose wisely. One path feels safe but rots your wealth. The other path may feel volatile but builds real security. Choose the one that preserves and grows your life over decades. The choice is yours. Every morning, you decide whether to passively watch your money disappear or actively grow it through rational, disciplined investment. Math doesn't lie. Psychology doesn't change the numbers. Rationality, patience, and process will win in the long term. You can be the person who protects and grows wealth rather than losing it silently, year after year. This is not complicated. It is consistent. It is achievable. And it is the foundation for real financial freedom.